March is starting off with some sell-side activity. In fact, this was the largest weekly implied move that the market priced in all year long. And on day one, we tagged that level. We had all types of news hitting the tape today, whether that be tariffs, whether that be ISM manufacturing PMI surprising to the downside, geopolitical risks intensifying, or the Atlanta Fed model forecasting nearly minus 3% GDP growth. We're going to talk about that on today's Stock Market Brief show. What I find very interesting is what the market is still pricing in for risk. Before we get to today's episode, got to thank the partners, Interactive Broker. If you want to start fresh, take a look there at the pinned comment or the description. Take a look at the link. And if you already have Interactive Brokers, make sure you still check out the campus where they offer a bunch of free resources, tools, blogs, webinars, podcasts, courses, and so much more. A big thanks to my Patreon group. As well, for those that are in there, I posted some new daily expected moves for the Mag 7, and I'm going to share those with all of you today in the section of this video. Let's get into today's episode. All right, people, welcome back to the show. So we had a lot of bombs hit the tape. Market did not like what it heard. We sold off into what the market expected as we discussed. Now, we still have a lot of stuff to come. We have the tariff deadline, right? That's kind of what drove these markets today. We have non-farm payroll. We get some more ISM data. We get all types of stuff happening. ISM data is tomorrow. That's ISM Services PM. Then we get a lot more Fed speak throughout the week, including on Thursday, and then a barrage of them on March 7th. That's Friday, along with the non-farm payrolls. If we take a look at the weekly chart of the S&P 500, we were down 1 week, 2 week, and this week is only day one, and it was already aggressive candle to the downside. If you look at the 11 sectors that make up the S&P 500, energy led the way to the downside. We'll talk about that and what drove that. Technology was right there with it, really being led by NVIDIA being down almost 9% on the trading session of AVGO. Broadcom was down 6%. And what you'll notice here is the large market cap names have been getting that big red, which is bringing these index products down. But overall, there's been still a lot of green on the screen. So I wouldn't consider this a full-blown capitulatory type move. Now, if you were trading intraday and you were watching Market Net Flow, right? I was live pretty much for the bulk of the trading session today, and our hands we had to sit on our hands if you're a alongside trader. This basically screamed, don't really bother trying to buy today's dip. We need to see more positive flow to feel more confident in this market. While this is going on, this is also matching the seasonal script here in the S&P 500. You typically get weakness into March, and then you see strength out through the midway. So if this is going to continue to hold like it's doing so far, it didn't do this the prior year, but if it's going to continue to do so, I mean, we're almost like about halfway through this as it stands right now. Now, as I stated, the weekly expected move was tagged day one on the SPY and the Qs, but that was a $12.28 expected move, which was larger than last week, which we tagged. It was larger than the week prior. The closest one it was at was a couple of weeks into the new year over here, where it was $11.74. So right now, the market sniffed out big risk. Did it already come, or do we have more to go? And that's what I find so interesting here is we already went through day one. We tagged the lower expected move, but look at this right now. This is looking at the expected move at $12 now and 82 cents, and that is with a day of trade out of the way. So it's still expecting not less risk now that we've already hit the implied move. It's expecting even more risk taking place. That could be because we have now moved the VIX futures curve into backwardation, where front month, we're looking at April right here, is above the May. And this can get more aggressive. It's not crazy right now, but right now it is telling us that, hey, we got problems here right now. And in terms of volatility, I want to remind everybody too, because when people hear volatility, they think the world's coming down, right? But volatility goes both directions. It's plus and minus. So I want people to be aware that you can still, if you go short and go super bear, you can still get your face ripped off in that type of environment. Okay, look at back month versus front month volatility. It's now slipping under for the first time in a while, under 1.0. We got there close. We got there intraday multiple times, but now we actually had to close under that level, which typically results in trying to find some sort of a bottom in the market or some sort of a bounce and a potential kind of reload to the downside. We'll look at that a little bit more. If we look at new lows in the NASDAQ, is this capitulatory? We're seeing a reading of 410 new lows as the market's pressing off. If we look at the last time we were at these levels, you can see that we saw this big spike up over here, and that was the bottom there in August. If we take a look at the safety trade going on, where we look at multiple relative strength lines to the S&P 500, gold, utilities, consumer staples, TLT, XLV, and defensive names, what do you notice going on? These are still continuing to tick up as it stands. So there has been this rotation, and has been for a while here in gold, in particularly, into more of a safe haven type trade. Now, as we're getting this sell side activity, we're getting a lot of overextended, oversold readings. We can look at the NASDAQ bullish percent index. You can see this is still relatively high as far as an index reading is, but on the RSI, you do see it moving into oversold conditions, creating a bullish divergence. We've seen that here and here. The big differences between these times is we were getting a 27 to 25% reading on the bullish percent index, whereas right now we're still in the 40s. Currently, if we take a look at the bullish percent index for the NYSE, same situation. This looks like it's going to slip down into be a positive divergence where you make a new low on the index, but you do create a higher low on the RSI. We saw this right over here. We saw this a couple of other times throughout history too. Right here was another one where you saw it kind of slip off there. But this is still relatively a higher reading where it was back here, October, November of the bottom in 2023. Now, this one's interesting too. Technology sector, bullish percent index. I mapped out all the times we had bearish divergences, and it resulted in the market correcting itself in the technology sector. But now we're moving into an oversold condition here right now, and sometimes from these levels can create bounces. So things are getting pretty frothy. As far as the reading goes, 33.8%. What that means basically is 33.8% of the stocks in the technology sector are on buy signals based off of those point and figure charts. And if you look to the left of the screen, we've been down here at 2025, 2025, 2025, even over here, 2020, 20 to 25, sorry, tongue-tied. And that was kind of where we found some supportive levels or some sort of a bounce. So we're kind of approaching that as we stand. We did get some news around Bitcoin over the weekend, and we saw a big move to the upside from around 80,000 back up to around 95,000. Today's move was pretty much faded completely as we back tested this prior breakdown area. The Sailor to Shift tool still remains under the flip line, and the flip line, sorry, right here is the rate of change between Bitcoin and gold on the 4-week rate of change. So for a buy signal to occur, I'd like to see this line tick up and close above there. You can trade it how you want to. Obviously, I traded it too the other day into the 200-day moving average just to be a little bit more quicker. But I do want to call out that we do not have a buy signal, buy trigger yet. It's still on its official sell signal, sell trigger. And that occurred on this week right over here. So this was the sell signal, I believe it was. Then we had the trigger. We went sideways for 3 weeks. And then we had the flush where we currently are. If we take a look at Bitcoin, we came into that 200-day moving average. Like I said, we bounced up. You can see the relative strength line between Bitcoin and SPX started crossing down in and around this range, and it got pretty weak after that point. So not a good signal there. For the bulls, you want to see it cross above and trend higher. Ethereum got just whacked today. This thing has also been below that declining 50-period EMA on the relative strength line. And also, you're just not getting the moves here. You're getting a lot of volatility. It's floating around that 2100 to 2200. So perhaps maybe this comes into play again at some point when we get a buy signal, buy trigger on the other tools. If we look at value or growth versus value, that rate of change is slipping to a little bit more deeper negative territory like it did here in August of 2023. And that did resolve to a bounce higher. Is it going to be a similar situation? I think that even if we're entering into what's called a bear market, it could be the early stages of one. But remember, even bear markets, guess what? You have face ripping rallies. If you look at the percent of stocks above the 20-day, moving average across the board, I mean, they're not really going anywhere, right? S&P 500, it's not oversold, it's not overbought. Over here, small caps, mid caps, 1500, which is a broader index, S&P 100, Dow Jones, NASDAQ 100, right? They're all holding up really well. The NASDAQ composite, however, that one is starting to creep lower to a low that we really haven't seen since August of 2023. You did see it over here in December of 2024, right at about those ranges. So if these start to get into oversold conditions, that is also an area where you want to really start looking for bounces. I've shown this big picture chart many times. It's the S&P 500 on the monthly time frame. And I want to just, because it's a new month, kind of paint this picture on some of these index products, because you are seeing some internals start to flip and start to turn. And if this actually means something, it's all going to look, once again, obvious in hind. So what do we got going on? We had the yield curve uninvert, right? And this is typically where, when we start to see it steepen and things can get pretty ugly, especially if you look back at the federal funds rate. This was also happening during the same times where we started cutting rates, and we started cutting rates. It started uninverting. We inverted again. It's kind of similar to what we saw here in 2020. It's kind of similar to what we saw right over here in 2006 going into 2007 to 2008, where we uninverted, we reinverted, and then we started moving back out of it. So kind of a similar script. And each time here, you can see that the market was pressing to new high territory until we started to, well, go into a recession, which I'd be honest with you, it kind of feels like that's being forced upon us right now. But we shall see how it all plays out. Now, I want to look at the larger picture charts here. S&P 500, I put down the percent price oscillator down here to give us an idea. Are things starting to curl over? Are things slowing down? Well, we've been in a trading range, so that means already these are going to start to flatten out, which it has. When you get a crossover, it is typically bearish. So the last time we had a bearish crossover was over here in 2022, and we started to kind of go into a bear market before eventually resolving itself. Now, these are lagging indicators, okay? So be mindful of that. If it keeps crossing over, but we move higher, you just watch it, because they are lagging indicators, okay? The last month here, you can see was somewhat of a, I don't know if you want to call it a spinning top or not. It's an indecision candle, meaning you have a small, tiny body, but the length of the wick on both sides represents indecision. And we're kind of floating in and around that monthly 5 EMA. Take a look at the NASDAQ 100. This was a bearish outside candle, right? And it was after a strong move to the upside. So these are shooting star type candles that if resolve or close lower, it might open the door for lower price action. So you'd have to start paying attention to where we saw more price action. Could it be 16,000? I mean, that sounds absolutely crazy to even imagine, but I mean, we weren't there all too long ago. So always keep that in the back pocket. You can see a month prior to that, 2 months prior to that, we saw a big reversal type candle too. And then we kind of traded around sideways. So if this is going to continue to the downside, take a look at the percent price oscillator over here. It's also starting to have that bearish crossover. And if you really, I mean, you could think of this as a divergence too, where you had a high, a higher high, you had a high, but you have a much lower high right here. So the internals on this move have weakened as well. IWM, same story, right? Same story. You have the bearish crossover on the monthly chart starting to take place. We're pulling back into the 20-month moving average over here, which we haven't really tested since this break over here. So it can act as a potential level of support. These things have been getting hammered. Maybe October or maybe middle of March, maybe we do find some strength in this market. But right now, it's still just some weaker, larger time charts starting to roll over. NASDAQ composite starting to do that bearish crossover here too as well. But overall, what do we see? Series of higher highs, higher lows. Things are good, right? But we are starting to see a little bit of weakness, consolidation, bigger pullbacks in the market. While this is taking place, we're seeing the 10-year yield drop off pretty dramatically in recent trade. You see oil that's been taking quite the beating too as well to the downside. We had some news today about OPEC Plus to proceed with the planned April oil output hike, and that is what drove the oil and the energy market today. 10-year yield by itself on a chart, we had the bearish crossover, right? So we had the PMO, price momentum oscillator over here, putting in a lower high. Price actually put in a higher high, okay? And then it resolved itself on the bearish crossover to the downside. So these oscillators can work on any time frame. They're fractal, and you can look for these divergences to play out. So it's important to note them. It's not an end-all be-all, but I think it's still important to note what we see going on as we're coming to the end of this quarter and the start of, obviously, this new month. So 10-year yield's been kind of coming off here. Where can we potentially go to? Well, right out of the gate, right, we saw prior resistance turn into prior support. So perhaps right at around 4.1 to 4.5, maybe we see this bounce a little bit. Okay, well, what if we want to look at a larger time chart? This is the monthly chart of TNX, and you can see this thing got absolutely crushed here during the COVID period, right? But then we came back and we broke through this massive trend line for 30 years plus, okay? 40, 50 years plus. This trend line is going back to the 80s. And you can see we had an RSI divergence over here. So you had a high, a lower high, you had a high, you had a higher high. And price actually did what? It started to come in and started to play down. You saw the same thing over here in the price percent oscillator, right? It was diverging. It's still coming down. So what happens if this thing sinks off? Well, I'd be paying attention to a back test on a larger period to this trend line, because sometimes when prior resistance breaks, it can become potential support. So what would that look like? Well, that could be potentially down to about 3% for the 10-year yield. I don't know if it's going to be some sort of straight line or we're going to go back up to 5%, or some people are saying 6% and the inflation is going to I don't know. And I'm not going to sit here to make narratives, but what I do know is if it starts coming off hard and fast, pay attention to 3%, okay? That'd be a level to watch. Bonds, you can see they've been acting somewhat of the flight to safety here too, outperforming the S&P 500, as you can see down here. So TLT has been doing rather well. When things get heated, right, they do need to consolidate. They do need to pull in. So if these pull in, you'll see a little bit of a bounce there in the 10-year as well, because they do have a tight correlation. Let's take a look at market conditions. All right, this was important because there's two things that I look at to determine when markets start to get a little bit rough, right? And that's the gamma flip line, which we've been howling on over here. The gamma flip line's at about 6,000, right? Give or take a little bit. It's a zone. It's never perfect, okay? But lately it's been acting pretty perfect. So when we slip into negative gamma territory, and this is a dynamic, it's constantly changing and adjusting, but we've been in negative gamma for like 6 trading days or so. Okay, this is a 4-hour chart, so about 6 trading days or so. And when that happens, volatility typically increases, right? To the upside, to the downside, both directions. Now, we've been talking about this range that we've been in, right? Kind of like 5,900 to 6,100 on ES, but I wanted to draw it out here on the SPX chart. And you can see that I have it down here at about 58.75-ish. It's not exact, but that's kind of coming back to where we had prior resistance here, and then it landed as support multiple times. We undercut it, right? And now we kind of undercut, we're actually below it right now. I wouldn't call this an undercut. We're below it right now. And then on above us, about 6,100, we came into it, we rejected, we came overcut, overshot, tagged it, overshot. And the reason why I'm bringing this up is because we're in theory, we're kind of still in this range, in my opinion, because when we've come down to these levels, this level, this level, this level, what do you notice? Just as if you see it from this level to this level to this level to this level to this level. What you notice here, what I notice is you see a very directional move to that point, but then you have a very strong rejection from the point, or a bounce from that point. So what I'm seeing here for me is you get down into these ranges, right? You have a strong push, a strong push, a strong push, strong push, strong push, right? But on the flip side of that, you had a strong move down, a strong move, pretty strong move, and then a very strong move here. So we're kind of just in this pull and push sort of area here, where once we break, we can have really directional risks start to pick up. And maybe that's what's happening now. But on the last video, I talked about the possibility for a bear trap. And I think that that is still a possibility, and or some sort of a dead cat bounce. This could have been the bear trap or dead cat bounce, but clearly today we reverse it and we dang near came into that 5,800 target, which is going to be critical to watch in incoming trade. Why? Because it is our put wall currently, and as this is growing in size, if we break it, they're starting to reach lower already. So we're coming to a very critical point here, meaning that you can be, but with caution, I guess, above 5,800, but right now in negative gamma and then below a bunch of declining 5-day moving averages, if you're trying to be tactical and if you're trying to be patient, you got to wait for the market to prove itself, and it ain't there yet, right? The direction of the 5-day moving average, we're below all of them: SPY, Q, IWM, semiconductors, XBI, DIA, and we're below the year-to-date volume weighted average price on all of these. SPY came to test it today and then got rejected. We were talking about it right here in the live stream and how it looked good, right? It started flagging, but the problem here was market net flow wasn't giving us confidence. And on top of that, direction of the 5-day moving average was not giving us confidence. So I kept on howling today about saying just, oh, I would prefer it to be a lot more better intraday to feel more confident to go long. Okay, take a look at Qs. Same thing. We came into the declining 5-day moving average, rejected. IWM, declining 5-day moving average, rejected. Okay, so it's going to take time for the market to come back, for the 5-day moving average to start to flatten out and start to turn back up. Right now, it's not there. Could it happen overnight? Absolutely. Right? We can get some good news, or the market gets news around the tariffs, right? Maybe the countries bend a knee and we get what we want, or whatever the case may be, and the market interprets it as the best thing ever, and then we all of a sudden gap up and we have a 2% day in these index products. That can happen. That kind of stuff does happen. So just be aware that the market's pricing in a boatload of risk still. Let's take a look at expected moves. All right, so the weekly expected move was 581.90 to the downside, 606 to the upside on SPY. That is the largest implied move for the week that we've had all year. Day one, tagged. We actually got underneath it and we started floating back up. Now, remember, it's very common. It's very common that once we come to these implied moves, that we see volatility in and around these levels. So to do this for the entire week, very common to see that type of stuff. However, if we get news that the market likes, we can see this thing rip right back up to unchanged, to potentially even higher. Okay, I want to be clear here. The market is still pricing in a boatload of risk. It is still looking at a larger expected move with already a day gone. So it's still looking at $12. Typically what happens if we have a $100 implied move and we go through a day, you're looking probably at about an $80 implied move, right? It drops off typically. That did not happen today, okay? So once again, be very cautious of that. Be very careful in this environment, knowing that the market is still pricing in the same exact type of risk, but we're already down here. This could be bullish. This could be bearish. I'm not trying to be directional bias here. I'm just telling you what the charts are currently telling us. We have oversold signals in some places, but we have poor market conditions in others. Okay, so the S&P 500 daily expected move for tomorrow is looking at about 577.38, this area. Just screenshot it, put the levels on your chart, okay? If you want the zones. Today, we broke the lower daily implied move, and we came right down to the weekly. So we'll see here if the risk tightens up a bit, but the daily was broken. The weekly is still holding. We're underneath last year's closing price. We're below week-to-date VWAP. We're below a declining 5-day moving average. You can see bounces, but every bounce should be met with some concern, not concern, but like, I don't know what the word I'm trying to use here, but you should not trust every bounce until we start to see the market conditions kind of change, if that makes sense. The Qs tagged the weekly lower AM. You can see pretty much to a point here, and we started bouncing from that level. Tomorrow's daily implied move brings us to around 490, 488, to and around 504. So if we come right back up here, I mean, if we come right back up, market's going to be like, dude, yeah, we're here. But really, that would still be below a declining 5-day moving average. It'd be right at the week-to-date VWAP, right? So this is what creates that two-sided trade, gets people all jacked and happy and confused and whatever the case may be. So just be aware, that's what the market's pricing for risk, and we've already reached down to pretty extreme levels while, right, we just tagged into backwardation, right, on the volatility index, we tagged into backwardation, and we're reaching pretty extreme levels on this stuff too. So my idea here would be, can we push off the lows a little bit more to 5,800, maybe undercut it a bit, and then all of a sudden see a bear trap take place where we can get that rip higher. And then we got to meet it with, I keep on trying to think of the word here. It's like on the tip of my tongue. But then we can look and see how either we're going to potentially reload or offload some of those longs, potentially reshort if you're a short seller, whatever the case may be there, okay? So I wanted to also start off, share at the end of this, the expected moves for the day on these products. So this is something that I'm considering putting in as a daily thing into the Patreon group now. All right, we do daily, weekly, monthly, quarterly expected moves. Those are all posted. They're all in there for a bunch of products. But the daily implied moves, those are only for like SPY, Q, IWM, some future products, ES, NQ, Ruddy, and SPX and all that stuff. But now I've been working on a formula for daily implied moves for these products, and I figured, why not? I'll just share them with you here today. These are for tomorrow, right? So if you trade Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla, the Mag 7 stocks is what they're typically called. These are the daily implied moves of risk. That's plus or minus. Plus or minus. These are the upper levels, right, for one standard deviation. And these are the 2 standard deviation levels. If all of a sudden the market really wants to get ripping and roaring, you can pay attention to those and just think of it in terms as a distribution curve, right? 68% of the time, will close within the upper and or lower level, and we usually tag those levels. These are a little bit differently how they're designed and built, but then we have the 2 standard deviations too if we're going to really kind of start moving for it. That's all I got for you on today's episode, everybody. It was a lot. Hope it helps out, gives you some insight to bigger picture stuff and then even the smaller picture stuff. Be careful and be safe out there. The market is pricing in a lot of risk. I don't know what's going to happen with all of this. No one really does. All I know is when volatility picks up, narratives get louder, but the best way to handle this is cutting down your position sizing, widening your stops, and being patient for the market to prove itself. Hope it helps. I'll see you later.